When you woke up this morning, nothing looked broken. There was no red headline scrolling across the screen, no emergency announcement, no markets in free fall. Your account balance looked the same as it did the night before. On the surface, everything appeared normal. And that is exactly the point. Because while you slept, something changed that does not show up on a price chart. It does not announce itself with panic. It does not look like a crisis. A group of people discovered that they could still see their money, but they could not use it. Not because they did anything wrong, not because of fraud, not because the system collapsed. Their access was simply paused, temporarily, for stability. This is not the story of money disappearing. It is the story of permission being withdrawn. Most people are trained to watch for crashes. They are told that danger only arrives with sirens and chaos. They believe that as long as their account still exists, as long as the number is still there, they are safe. But the modern financial system does not need to take your money to control it. It only needs to control when, how, and whether you can reach it. Ownership has become a background detail. Access is the real lever. This isn't coincidence. Systems do not behave randomly at scale. When the same type of restriction appears quietly, selectively, and without warning, it is not an accident. It is a signal that a threshold has been crossed. The most important thing to understand is that nothing failed. The system worked exactly as designed. Here is the uncomfortable realization most people are not prepared for. Your money does not live where you think it does. It does not sit patiently waiting for you untouched until you decide to use it. It moves through layers of clearing settlement liquidity rules and priority hierarchies. Under normal conditions, those layers are invisible. Under stress, they become gates, and gates can close. When access is delayed, the language is always calm. Temporary restriction, routine review, stability measure. These phrases are not chosen by accident. They are chosen because they are true within the logic of the system. From the system's point of view, slowing access for some users is not a failure. It is a risk management decision. The people affected were not warned ahead of time. They did not receive a countdown. There was no option to opt out. The restriction appeared after the fact, framed as a technical necessity. For them, the lesson arrived fully formed. They learned that possession and usability are not the same thing. This pattern has appeared before, long before digital accounts and online dashboards existed. Every complex financial system eventually faces moments where demand for access rises faster than the system can safely accommodate. When that happens, the system does not ask who owns what. It asks who must be protected first. Once the stage begins, the rules change in a subtle but critical way. The system stops treating all participants equally and starts treating them hierarchically. Priority is assigned. Access is sequenced. Some lanes move freely while others slow to a stop. From the outside, it looks unfair. From the inside, it looks necessary. What makes this moment dangerous is not the scale of the restriction, but the precedent it establishes. A system that can pause access once can do it again. A system that frames restriction as stability can expand that definition whenever conditions demand it, and conditions are rarely static. Notice what did not happen. There was no vote, no public debate, no announcement that a new rule had been introduced. The change occurred through process, not proclamation. That is how modern systems evolve, quietly, internally justified by complexity. The people who lost access were not selected at random. They were selected because the system could afford to slow them down. That is how prioritization works. It is not personal, it is structural. The system protects itself first, then the largest nodes within it, then everyone else in descending order of perceived importance. This is where most explanations stop. They reassure you that this was temporary, that access will be restored, that nothing fundamental has changed. But that reassurance misses the deeper point. The event itself matters less than the capability it revealed. If access can be restricted without crisis, without collapse, without explanation, then access is no longer a guaranteed right. It is a conditional privilege managed dynamically. That is not a prediction. It is a description of how complex systems behave under pressure. The real question is not whether this specific restriction will be lifted. The real question is what happens the next time stress increases, liquidity tightens, or priorities shift again. Because systems do not unlearn capabilities. Once a mechanism exists, it becomes part of the toolkit. You are not being asked to panic. You are being asked to notice, to recognize that the risk is no longer confined to losing money, but to losing timing optionality and control. In a system where access can be delayed, timing becomes everything. And those who move first are rarely the ones informed last. This isn't coincidence. It is alignment. Multiple pressures converging into the same operational response. Not loudly, not dramatically, but efficiently. The system did not break. It revealed itself. And once you understand that, you begin to see the real shift that happened while you slept. Most people believe the central risk in finance is loss of value, loss of savings, loss of purchasing power. They are taught to measure danger by watching numbers go down. Red candles, falling balances, market crashes. As long as those signals do not appear, they assume the system is working in their favor. That belief is outdated. The modern financial system does not need prices to fall in order to exert control. It does not need to erase balances or confiscate assets. It operates on a far quieter axis, one that most people never examine until it is used against them. The axis is access. Ownership and access are no longer the same thing. They used to be tightly linked. If you owned something, you could use it. If you held money, you could spend it. If you had savings, you could move them when needed. That assumption was valid in simpler systems. It is not valid in layered digital intermediated systems, where every action passes through gates you do not control. This isn't coincidence. The separation between ownership and access did not happen accidentally. It emerged as systems became larger, faster, and more fragile. When complexity increases, control shifts away from individuals and toward processes. Those processes are designed to optimize stability, not individual freedom. To understand the risk, you have to change the question you ask. And the old question was, is my money safe? The new question is, under what conditions can I use it? Those are not the same question, and they produce very different answers. From the system's point of view, your account is not a vault. It is a node. It sits inside a network of obligations, timing rules, counterparties, and risk models. Under normal conditions, that network feels frictionless, transactions clear, transfers settle, access feels immediate, but that smoothness is conditional. It exists only as long as system-wide stress remains within acceptable bounds. When stress increases, the system does not respond by asking for permission. It responds by adjusting priority. Access becomes sequenced. Some transactions move first, others wait. Some users are waved through. Others are asked to stand aside. This is not a moral judgment. It is a mechanical response. This pattern has appeared before, even in eras without digital finance. Whenever systems face competing claims and limited capacity, they ration not by ownership, but by importance. Who matters most to system continuity? Who can be delayed without triggering further instability? That logic has never changed. Only the tools have. What makes the current environment different is how invisible this rationing has become. There is no sign on the door saying access is limited. There is no public announcement that priorities have been reordered. The change happens inside code compliance language and internal risk thresholds. From the outside, it looks like a minor inconvenience. From the inside, it is a structural shift. Once this stage begins, access is no longer binary. It is no longer simply allowed or denied. It becomes conditional, revocable, adjustable. Time limits appear, reviews are introduced, exceptions are quietly granted to some and not others. The system does not explain these differences because, from its perspective, they are operational details. This reframing is uncomfortable because it removes a sense of certainty people rely on. Many assume that legality guarantees usability, that if something is allowed, it must also be accessible. But legality governs ownership. Usability is governed by system capacity and risk tolerance. Those are managed dynamically, not democratically. The most dangerous misunderstanding is believing that these controls only apply in extreme emergencies. They do not. They are tested, refined, and normalized during periods that still look calm on the surface. Small restrictions today establish precedents for larger ones later. Temporary measures become templates. Quiet adjustments become standard operating procedure. This is why focusing only on crashes misses the real transition. The shift happens before panic, not after. It happens while people are still debating whether anything is wrong. By the time losses appear on a screen, access hierarchies have already been built. The reframing is simple but profound. The risk is no longer just what you own. The risk is where you sit in the priority stack when the system decides who moves first. That stack is invisible, constantly changing, and not disclosed in advance. Understanding this does not require fear. It requires clarity. Once you see that access is the true control mechanism, many otherwise confusing decisions start to make sense. Delays, restrictions, reviews, and selective permissions are not glitches. They are signals. The system is not preparing for collapse. It is preparing for management. And management always begins with deciding who can move when and under what conditions. To understand what is happening, the isolated event has to be placed into a larger structure. Systems do not improvise under pressure. They follow patterns. When the same type of response appears across different eras, technologies, and institutions, it stops being anecdotal and starts being structural. This pattern has appeared before, and it always unfolds in stages. The first stage is the stability narrative. Publicly, the system emphasizes resilience. Officials, institutions, and spokespeople repeat that everything is functioning as intended. Markets are orderly. Liquidity is sufficient. Risk is contained. This messaging is not deception. At this stage, the system truly believes it is stable, or at least stable enough to proceed without alarm. Confidence is treated as a resource that must be protected. The second stage is quiet stress. Beneath the surface, pressures begin to build that are not visible to the general public. Liquidity mismatches widen, settlement timelines stretch, exposure concentrations become uncomfortable. None of this is dramatic on its own. These stresses show up in internal dashboards, risk models, and back-office conversations, not in headlines. The system still functions, but with less margin for error. The third stage is the internal rule update. This is where the real shift begins. Policies are adjusted quietly, thresholds are tweaked, definitions are refined. These changes rarely require public disclosure because they fall within existing authority. They are framed as technical updates, compliance adjustments, or routine reviews. To the system, this is preventative maintenance. To users, it is invisible. The fourth stage is selective restriction. Access is limited for a small subset of participants. The scope is intentionally narrow. The language is careful. Temporary measures are introduced to address specific concerns. This is not done to punish. It is done to test. The system observes how restrictions affect behavior, liquidity, flow, and public response. Resistance is measured. Friction is evaluated. The fifth stage is priority access. Once selective restriction proves manageable, the hierarchy becomes clearer. Certain participants are routed around constraints. Transactions associated with systemically important actors move faster. Others wait longer. This prioritization may not be officially acknowledged, but it is operationally enforced. From the system's perspective, this is rational. Continuity depends on keeping the largest nodes functioning. The sixth stage is normalization. What began as an exception becomes an accepted condition. Temporary language remains, but timelines stretch. Reviews repeat. Restrictions feel less shocking with each occurrence. The public adapts. Expectations reset. Access is no longer assumed to be immediate. It is assumed to be conditional. This pattern does not require a crash to advance. In fact, it progresses most effectively without one. Crises invite scrutiny. Quiet transitions do not. By the time a visible disruption occurs, the access hierarchy is already in place and functioning. Once this stage begins, reversal is rare. Systems rarely discard tools that proved useful under stress. A mechanism that successfully managed risk once becomes part of the standard response framework. It may be dormant for long periods, but it remains available. What matters most is not where the system is today, but where it is willing to go. Each completed stage lowers the threshold for the next. Each test expands the acceptable range of control. Over time, what once would have seemed unthinkable becomes operationally normal. This is why focusing on intent misses the point. The system does not need malicious intent to produce restrictive outcomes. It only needs incentives aligned around stability and continuity. When those incentives dominate, access becomes something to be managed, not guaranteed. The pattern is not driven by ideology. It is driven by scale. Large systems cannot allow unrestricted simultaneous access during periods of strain. They must sequence demand. They must choose who waits. The only question is how openly that choice is acknowledged. Understanding this pattern reframes the event entirely. It is no longer a surprise or an anomaly. It is a recognizable stage in a longer process, a process that is repeated across financial history, adapting to new tools, but preserving the same underlying logic. And once you recognize the pattern, the event stops looking isolated. It starts looking positioned. To see why access can be restricted without warning, you have to look beneath the interface. What you see as an account is not a container holding money. It is an instruction layer sitting on top of a much larger machine. That machine is designed to manage flows, timing, and risk across millions of participants simultaneously. At the core of the system is settlement, not balance. Every transaction triggers a chain of obligations that must be cleared in the correct order. Payments do not move instantly from one person to another. They move through intermediaries, netting processes, liquidity buffers, and risk checks. Under calm conditions, this complexity is hidden. Under stress, it becomes decisive. This isn't coincidence. The same architecture exists across modern finance because it solves a specific problem. When volume spikes or confidence wavers, the system must prevent a cascade. A cascade happens when too many participants demand immediate access at the same time. To stop that, the system introduces friction selectively. The mechanism begins with liquidity management. Institutions are required to hold buffers, but those buffers are not infinite. When projected outflows approach internal thresholds, automated controls activate. These controls are not discretionary in the way people imagine. They are embedded in risk models that update continuously based on market conditions, counterparty exposure, and settlement congestion. When a threshold is approached, the system does not shut down. It slows. And it does not slow evenly. It slows where the impact is least likely to propagate. This is why access restrictions appear selective. The system is designed to protect itself first, not to treat every participant identically. Clearing priority is the next layer. Some transactions are considered systemically important because they support broader market function. Others are considered deferrable. This distinction exists in policy manuals, but it is rarely discussed publicly. During stress transactions tied to major institutions, large counterparties or essential infrastructure are routed first. Smaller, less critical flows are delayed. From the outside, this looks arbitrary. From the inside, it is the difference between continuity and breakdown. This pattern has appeared before in different forms. In physical banking systems, it took the form of withdrawal limits and bank holidays. In modern systems, it takes the form of access reviews, temporary holds, and compliance-based delays. The language changes, but the mechanism is the same. Demand is sequenced to preserve order. Technology makes this process faster and quieter. Algorithms do not hesitate. They do not negotiate. They respond to inputs. If volatility increases, if correlations tighten, if counterparties show stress, the system adjusts access automatically. By the time a human explanation is prepared, the change has already occurred. Once this stage begins, the logic becomes self-reinforcing. A small restriction reduces immediate outflows. Reduced outflows stabilize projections. Stabilized projections validate the restriction. The system reads this as success. That success encourages further use of the same tool the next time conditions tighten. Another critical mechanism is legal authority. Most access controls operate within existing agreements. The language allowing delay or suspension already exists. It was added years earlier during periods of reform or modernization. At the time, it was framed as protection. In practice, it is flexibility. Flexibility for the system, not for the user. This is why access can be limited without a declaration of emergency. No new law is required. No extraordinary power needs to be invoked. The mechanism operates inside the rules as written. From a legal standpoint, nothing improper occurs. From a user standpoint, expectations are quietly violated. The final layer is signaling. The system pays close attention to reaction. If restrictions trigger panic backlash or unintended consequences, they are adjusted. If they pass with minimal resistance, they are noted as viable. Over time, the system learns where the boundaries are. Those boundaries tend to move in one direction. This isn't coincidence. Large systems evolve through feedback. Actions that reduce risk without provoking disruption are retained. Actions that cause instability are avoided. Access control has repeatedly proven to be an effective stabilizer in the short term. That makes it attractive regardless of long-term implications. Understanding the mechanism clarifies why explanations often feel unsatisfying. The system is not lying when it says restrictions are temporary or technical. Those statements are true within its framework. What is missing is the acknowledgement that temporary measures, once validated, become permanent options. The mechanism does not care about individual intent or circumstance. It responds to aggregates. You are not assessed as a person. You are assessed as part of a category. Categories are easier to manage than individuals. They are also easier to deprioritize. Once this stage begins, access stops being a guarantee and starts being a variable. That variable is adjusted in real time based on conditions you do not control and often cannot see. The system does not need to explain this because explanation is not required for operation. This is how control shifts in modern finance. Not through seizure, but through sequencing. Not through collapse, but through management. And once you understand the mechanism, the earlier events stop looking surprising. They look procedural. What makes the current moment difficult to recognize is not that it is unprecedented, but that it looks modern. Digital interfaces create the illusion of novelty. In reality, the logic behind access control is older than electronic finance. Whenever financial systems grow large enough to threaten their own stability, they converge on the same solution delay sequence and prioritize access rather than openly confiscate assets. This pattern has appeared before under very different political systems and technological constraints, and it has always followed the same internal reasoning. When simultaneous claims exceed what the system can safely honor, the system does not ask who owns what. It asks which claims must be honored first to prevent wider failure. In the early 20th century, this logic appeared as bank holidays. Depositors still legally owned their money. The banks did not deny that ownership. They simply closed their doors. Access was suspended, not abolished. The justification was always stability. Time was needed to restore confidence, assess reserves, and prevent disorderly withdrawals. In practice, those pauses taught the public a lasting lesson. Possession and availability are not the same thing. Later, the same mechanism appeared through withdrawal limits. Rather than closing entirely, institutions allowed partial access. Small amounts were permitted. Larger amounts required approval. The system framed this as fairness, ensuring that everyone received something. But the underlying function was sequencing. Demand was slowed to match capacity. Priority was enforced quietly through limits rather than announcements. This pattern repeated again with capital controls. Funds were not seized, accounts were not erased. Instead, transfers were delayed, capped, or routed through additional approvals. The official language emphasized temporary necessity. The practical effect was that certain uses of money were suspended while others continued uninterrupted. The hierarchy of access became visible only to those who collided with it. This pattern has appeared before during currency reforms as well. In many cases, deposits remained legally valid, but conversion timelines differed. Large institutional holders were processed first. Smaller holders waited longer. In some cases, the waiting period itself reduced the real value of access through inflation or devaluation. The system never needed to announce a loss. Time did the work. Across these examples, the same features repeat. Restrictions are introduced quietly. They are justified as technical or temporary. They target behavior rather than ownership. And they disproportionately affect those without leverage influence or systemic importance. The language varies, but the function remains consistent. This isn't coincidence. History shows that overt seizure is politically costly and destabilizing. Access control is cheaper, cleaner, and more defensible. It preserves the appearance of legality while granting the system room to maneuver. That is why it has been favored repeatedly across ideologies and centuries. What is often forgotten is that these measures rarely disappear entirely. Once introduced, they tend to resurface in modified form. Bank holidays evolve into withdrawal limits. Withdrawal limits evolve into transfer controls. Transfer controls evolve into conditional access rules embedded in contracts and platforms. Each step feels incremental. Together, they form a durable architecture of control. Another consistent feature is timing. These measures are not introduced at the peak of crisis. They are introduced in anticipation of it. Systems that wait for collapse lose the ability to manage outcomes. Systems that act early retain optionality. That is why access restrictions often appear when conditions still look calm to the public. Once this stage begins, historical precedent suggests that the direction is one way. Access becomes a policy tool. Policy tools, once proven effective, are reused. They may be softened, rebranded, or partially relaxed, but they are rarely abandoned. The justification may change. The authority remains. History does not show a return to simpler assumptions once complexity reaches a certain scale. It shows adaptation. Systems become more layered, more conditional, and more selective. The individuals within those systems are expected to adjust their expectations accordingly. The lesson from history is not that access will vanish entirely. It is that access will no longer be uniform. It will depend on timing, category, and perceived importance to system stability. Those factors have always mattered. Modern systems simply apply them with greater precision and less visibility. When viewed through this lens, the present moment does not signal an anomaly. It signals continuity. The tools being used now are refinements of tools used many times before. The names have changed. The interfaces have changed. The underlying logic has not. And once you recognize that logic, it becomes clear that what is unfolding is not a deviation from historical behavior, but its modern expression. When the pattern is laid over the present environment, the alignment becomes difficult to dismiss. The signals are not dramatic, but they are consistent. Language has shifted. Procedures have slowed. Priorities have become more explicit. None of these changes are announced as a turning point, yet together they mark a transition in how access is treated. The most important detail is timing. These adjustments are not appearing in the middle of a visible crisis. They are appearing while markets still function, while accounts still display balances, while daily life continues without interruption. That is precisely when systems prefer to act. Early intervention preserves control. Late intervention invites panic. You can see this in the way access is now framed. Delays are described as reviews. Restrictions are described as safeguards. Sequencing is described as optimization. Each term sounds benign in isolation. Taken together, they reveal a system that is actively managing who moves first and who waits. The public-facing explanation emphasizes protection. The operational reality emphasizes prioritization. This isn't coincidence. The current environment combines several pressures that strain access even without a headline crisis. Settlement volumes are higher. Counterparty exposure is more concentrated. Liquidity is more dependent on confidence than on cash reserves. In such conditions, unrestricted simultaneous access becomes a liability rather than a feature. What is different now is not the existence of access control, but how seamlessly it integrates into everyday operations. Restrictions no longer require physical closures or emergency declarations. They can be applied account by account, transaction by transaction, moment by moment. This granularity allows the system to intervene without drawing attention to itself. Once this stage begins, the system's behavior becomes predictive rather than reactive. It does not wait for withdrawals to spike. It anticipates where pressure might emerge and adjusts access preemptively. This is why some users experience friction while others do not. The difference is not luck, it is categorization. Another present-day signal is the widening gap between institutional and individual experience. Large entities continue to transact smoothly, even as smaller participants encounter delays or additional requirements. This divergence is not accidental. Institutions are embedded within the system's stability framework. Individuals are external to it. When choices must be made, the system favors continuity over convenience. This pattern has appeared before, but modern infrastructure accelerates it. Automated risk scoring, real-time monitoring, and centralized oversight compress decision cycles. What once took days or weeks now happens instantly. By the time a user notices a restriction, the decision has already been made and justified internally. And once this stage begins, the public narrative often lags behind reality. Officials reassure because reassurance is appropriate from their vantage point. The system is stable. That stability, however, is being actively maintained through tools that quietly reshape access. The absence of panic is not proof that nothing is happening. It is evidence that the measures are working as intended. Applied to the present, the pattern suggests that what looks like isolated friction is actually early normalization. The system is testing tolerance, it is observing reactions, it is measuring how much access can be adjusted without triggering resistance. Each successful adjustment expands the range of acceptable control. This does not mean that access will disappear. It means that access will be conditional in ways that are not evenly distributed or clearly communicated. Timing will matter more. Categories will matter more. Priority will matter more. These factors are already influencing outcomes, even if most people have not yet connected them. Once this stage begins, the most significant change is psychological. Expectations quietly reset. People stop assuming immediacy. They begin to plan around delays. What was once seen as an exception becomes part of the landscape. That shift happens gradually, almost imperceptibly. Applying the pattern to the present reveals a system that is not breaking but tightening. It is not collapsing but organizing. The controls being used are subtle precisely because subtlety reduces resistance. The absence of drama is not reassuring, it is strategic. Seen this way, the current moment is less about what has already happened and more about what the system has demonstrated it is willing to do. The capability has been exercised, the response has been measured, the result has been absorbed. And that is how transitions actually occur. Not with an announcement, but with a quiet adjustment that becomes the new baseline. When all the pieces are placed together, the conclusion is not dramatic, it is unavoidable. Systems that acquire the ability to manage access do not relinquish it. They may soften its application. They may change the language used to justify it. But they do not return to a state where access is unconditional, immediate, and equal for all participants. This isn't coincidence. It is a property of scale. Once a system reaches a size where unrestricted access threatens its own continuity control, becomes a requirement rather than a choice. At that point, access stops being a right and becomes a variable. Variables are adjusted, rights are not. The most important shift is not legal, it is operational. Ownership remains intact on paper, but paper no longer governs outcomes. Outcomes are governed by process. Process is governed by priority. Priority is governed by perceived systemic importance. This chain does not need to be announced to function. It only needs to exist. Once this stage begins, the idea that everything will return to the way it was becomes a comforting fiction. Temporary measures do not roll back to zero. They settle into precedent. Each use validates the mechanism. Each validation lowers the barrier for future use. Over time, the exceptional becomes normal, not because people agree with it, but because the system no longer offers an alternative. This pattern has appeared before, and the outcome is consistent. The system does not reverse course after demonstrating effective control. It refines it. It embeds it deeper into infrastructure contracts and expectations. What was once visible becomes implicit. What was once debated becomes procedural. There is no moment where someone declares that access is no longer guaranteed. That declaration is unnecessary. The guarantee dissolves through practice. Users learn through experience that timing matters, categories matter, and priority matters. They adapt because adaptation is easier than resistance. The system counts on that. Once this stage begins, the real divide is no longer between those who have money and those who do not. It is between those who can move when they need to and those who must wait. Waiting is not neutral. Waiting transfers optionality. It transfers leverage. It transfers outcomes. The system does not view this as unfair. It views it as efficient. Efficiency in this context means preserving stability at the lowest political cost. Access control achieves that better than overt seizure or public confrontation. It keeps the machinery running while quietly reallocating inconvenience downward. This is why focusing on reassurance misses the point. The system can be stable and still restrictive. Stability does not imply freedom of access. In fact, stability increasingly depends on managing access carefully. The two are no longer opposites. They are linked. Once this stage begins, the question is no longer whether access will be conditional. That question has already been answered. The question becomes how often conditions will change, how narrowly they will be applied, and how clearly they will be communicated. History suggests that clarity decreases as reliance on the mechanism increases. The conclusion, then, is not that something has gone wrong. It is that something has been revealed. The system has shown what it values most when trade-offs appear. Continuity over convenience, order over immediacy, control over assumption. That revelation does not require panic. It requires recognition. Because systems do not announce their final form. They arrive there incrementally, one justified adjustment at a time. And once this stage begins, there is no returning to the belief that access is automatic simply because ownership exists. That belief belonged to an earlier phase. The system has moved on. At this stage, reacting emotionally is the most common mistake. Panic feels productive, but it rarely improves outcomes. The system does not respond to urgency from individuals. It responds to structure. The only useful response, therefore, is to realign how you think about your position within that structure. The first adjustment is conceptual. You have to stop evaluating safety based solely on ownership and start evaluating it based on access pathways, not whether something belongs to you in principle, but how many layers sit between you and its use. Every layer introduces timing risk. Every intermediary introduces prioritization risk. The more layers involved, the more conditions must remain favorable for access to be immediate. This isn't coincidence. When systems tighten, they do not tighten everywhere equally. They tighten at choke points. Your exposure is not defined by what you own, but by how concentrated your access routes are. A single point of access may feel efficient during calm periods, but it becomes fragile when conditions shift. Resilience comes from optionality, not from confidence. The second adjustment is behavioral. Systems track patterns. They observe who moves early and who waits for confirmation. Those who wait for clarity often receive it after options have narrowed. This does not mean acting rashly. It means understanding that delays are themselves signals. When processes slow without explanation, the slowdown is part of the message. Once this stage begins, timing becomes more valuable than precision. Perfect information rarely arrives before decisions must be made. The system moves on probabilities, not certainties. Individuals who expect guarantees before acting often discover that the window for low-friction movement has already closed. The third adjustment is structural. Dependence on a single channel, a single institution, or a single interface creates vulnerability. Systems under stress favor continuity over convenience, and continuity favors those who can operate across multiple routes. This does not require complexity for its own sake. It requires redundancy. Redundancy is inefficient in calm periods and indispensable in constrained ones. This pattern has appeared before. Those who maintained optionality were not necessarily the most informed, but they were the least constrained. They did not need to predict the exact moment conditions changed. They only needed to avoid being trapped when they did. Another critical adjustment is psychological. Expectation management matters. If you assume access will always be immediate, any delay feels like a crisis. If you assume access may be conditional delays, become manageable variables, systems exploit expectation gaps. Closing that gap restores agency even when conditions are imperfect. Once this stage begins, asking the right questions matters more than demanding the right answers. Instead of asking whether something is allowed, the more useful question is under what conditions it is prioritized. Instead of asking whether access is permanent, the more relevant question is how easily it can be paused. These questions do not produce comforting answers, but they produce realistic ones. The final adjustment is restraint. Overreacting creates noise that the system ignores. Quiet positioning preserves flexibility. Large systems respond to aggregates, not to individual declarations. The goal is not to challenge the system, but to understand how it allocates movement and to avoid being placed at the back of the queue by default. This is not about withdrawing from the system or attempting to outsmart it. That framing misunderstands the scale involved. It is about recognizing that access is now a managed resource and positioning yourself accordingly. Managed resources reward those who plan for constraints rather than assuming abundance. Once this stage begins, the most effective action is not dramatic. It is deliberate. It is the slow reorientation away from assumptions that no longer hold and towards structures that preserve choice when timing matters most. The system has already shown you what it can do. The remaining question is how you respond to that knowledge. There is one question this analysis deliberately has not answered yet. Not because it is unimportant, but because it cannot be addressed until everything before it is understood. If access can be delayed, sequenced, and selectively restored, then access is no longer neutral. It follows rules, and rules imply ranking. The moment access becomes managed, the system must decide who moves first and who waits. That decision is not random. It is not evenly distributed. It is based on criteria that are rarely disclosed and almost never debated publicly. Those criteria determine outcomes long before prices move or headlines appear. This isn't coincidence. Every system that manages access eventually develops lanes. Some lanes are wide and fast, others narrow and slow. Most people assume they are in the same lane as everyone else until they discover too late that they are not. The event that began this discussion was not about denial. It was about ordering. It was about the quiet emergence of priority. Once priority exists, equality of access no longer does. And once equality disappears, understanding where you stand becomes more important than understanding what you own. The next logical step then is not to ask whether access will return to normal. Normal has already changed. The next step is to ask how the system decides who receives priority access when constraints tighten again, because that decision shapes everything that follows. This pattern has appeared before, and each time it does, those who recognize the hierarchy early adapt differently from those who assume the system treats all participants the same. The difference is not knowledge of markets. It is awareness of structure. In the next part, the focus shifts to that structure, to the invisible tiers that determine who moves freely and who encounters friction. to the signals that reveal where priority is being assigned before it becomes obvious, and to the behaviors that distinguish those who are routed forward from those who are quietly delayed. Because once access is no longer guaranteed, the most important question is no longer whether the door is open. It is whether you are standing in the right line when it matters.